Welcome to FT Markets. Emerging markets, currencies, stocks and bonds have been in a state of turmoil in recent months, leading to the obvious question of whether we are getting close to a bottom in the stress rippling through financial markets. With me to discuss this and other topics is David Lubin, Head of Emerging Markets Economics at Citi. Welcome, David. Could you take us through what you see has been happening in the emerging markets currency market lately?
Well, I think the most astonishing thing is just how deep the adjustment has been in emerging foreign exchange markets. If you look at an average of real exchange rates, trade-weighted, inflation-adjusted exchange rates in EM, the average real exchange rate... All right, there it is. The average real exchange rate of EM is as cheap as it was at the height of the Lehman crisis and is nearly as cheap as it was in the late 1990s and the early 2000s. And remember, this was a time when emerging economies had been through 2 decades of intermittent financial crisis. The problem, though, is that it's very difficult to say now, well, enough is enough, because the problem facing emerging economies these days is a breakdown of the growth model. Emerging economies have been hit by a very nasty negative shock coming from the Chinese slowdown, coming from the collapse of global trade growth, and they can't really use fiscal policy or domestic credit policy to offset the negative external shock that they've been received.
And recently, I think we've seen some moves by the Chinese government to start to reinvigorate their economy. So do you think that those measures will create a kind of countercurrent and create a bottom in the financial markets?
Well, it certainly seems to be the case that Chinese policymakers have made some effort to deliver more stimulus. But it's important to remember that the Chinese slowdown generates a lot less panic in Beijing than it does in the rest of the world. Chinese policymakers are properly committed to changing the structure of the economy. And so the stimulus measures that they've delivered, for example, having the Chinese Development Bank issue bonds to the Postal Savings Bank in order to finance infrastructure projects, these kinds of stimulus measures are relatively modest, relatively limited, and are probably, or certainly not going to kind of bring us back to rapid investment-led growth model that China was enjoying between 2002 and 2013, which provided such a positive shock to emerging economies. And the problem that the rest of the developing world has is that if you have a broken growth model, it's very difficult for market participants to know what the equilibrium exchange rate is. It's very difficult to know what the fair value is for the currency if you don't know how the economy functions. And that means that we don't really know if we're at an end of this adjustment.
And we have a chart here on the pension situation in China. How does that affect the policy mix in China?
Yes. Well, the point I want to make with this chart is really that China's policy options, its ability to deliver endless amounts of stimulus, are relatively limited. The Chinese Finance Ministry has a reputation for being rather conservative, and one of the reasons for that reputation, as is the case in Korea, as is the case in Germany, is that you've got a country with an aging population, and as a result of that, the present value of pension liabilities, as we see from data from the IMF here, is very large by international standards, and that's likely to incline the Chinese Finance Ministry to be relatively cautious now.
We see here it's over 80%. So how does this play out in other areas of the Chinese situation, such as capital outflows?
Well, just as fiscal policy has some constraints because the Chinese Finance Ministry has some reasons to be conservative, there's also, I think, constraints facing monetary policy. Of course, we've seen some easing in monetary policy in the last year, but if the Chinese central bank cuts interest rates too low, then that could have the effect of accelerating capital outflows.
And we have a chart on capital outflows showing how persistent they've been over the last few years.
Yeah, capital outflows have been a sort of dominant theme of the Chinese balance of payments since April last year. And the risk is that these capital outflows are more likely to continue than not. And I say that for 2 reasons. One is that between the years 2009 and 2013, China sucked in a vast inflow of speculative money. And the reasons for that inflow have now broken down. The inflow took place because US dollar interest rates were very low, Chinese interest rates were higher, and the exchange rate was predictably stable. Now all of those three magnets that were kind of sucking in capital inflows to China have kind of broken down, and so there's a sort of speculative capital outflow. That's one point. The second point is that over the last 2 or 3 decades, Chinese firms and Chinese households were accumulating wealth in renminbi. Now, they had to do that because of Chinese capital controls, and they were happy to do that because for most of this period, the Chinese renminbi was obviously undervalued, and if you're long an undervalued currency, you're very happy. But now things are changing. The Chinese capital account is being liberalized at the margin, and the renminbi is not obviously undervalued anymore. And so there's a kind of pent-up demand for international portfolio diversification, and that, I think, will lead to persistent capital outflows from China.
Thank you very much, David. So it seems that in spite of the measures that the Chinese government is taking to reinvigorate their economy, this may not be enough to put a base under the stress that we see rippling through emerging markets worldwide.